Hi, welcome to Financial Management, second lesson. My name is Mr. Anthony Moremi, and I'm the lecturer who will be taking you through financial accounting, or rather, in your case, Introduction to Accounting, which is the same thing. So, in the first lesson, we shall look at the first topic of financial accounting, that is Introduction to Accounting. So under this topic, we shall look at the various definitions of accounting. We shall define bookkeeping, which is a term that is quite similar to financial accounting. We shall look at the functions and objectives of accounting. We shall look at the users of accounting information. And we shall also look at the balance sheet equation and various other introductory items in accounting. So to begin, we look at the accounting definition, and we shall see, as you can see there, we have two definitions of accounting. One, accounting is defined as a process of recording, classifying, and summarizing in a significant manner, and in terms of money, transactions, and events, which are in part at least of a financial character, and interpreting the result thereof. We also have a second definition of accounting, which is defined as the analysis, classification, and recording of financial transactions and the ascertainment of how such transactions affect the financial performance and position of a business. So by looking at those two definitions of accounting, you notice that there are some key terms in that definition. The key terms there have been underlined, like we have recording, we have classifying, we have summarizing in that definition. And we also have in the second definition, we have the analysis, the classification, and the recording of business transactions. Yeah. So there are some key terms that should not miss in a proper definition of accounting. Yeah. So we have it's a process of recording, is a process of classifying, the process of summarizing, of business transactions, and reporting the impact of these transactions to a business. So when called upon to define what accounting is, you don't have to give a crammed definition. All you need to do is to note that there are some key definitions, the key terms. And these key terms are all about the activities of accounting. Yeah, that involve recording of business transactions, that involve classifying of these transactions, and in this case in accounting, you classify into various accounts, like we have capital account, debtors account, and so on. And then we analyze, we classify into accounts, and then we analyze. To analyze is to be able to get to know the impact of the transactions on the financial performance and position of a business. So we analyze the impact of a transaction on the performance and financial position of a business, and then we do the summaries, and by summarizing we come up with reports, yeah, on the impact of business transactions on its profitability and on its on its financial position as at a given date. So down here we have the elements of an accounting definition. So I've said that you don't have to cram the definition of accounting. All you need to know is to note the key terms, of which these key terms are the activities, the normal activities of an accounting process. Yeah, the accounting is a process, and being that it's a process, we can say that accounting is a series of activities. Yeah, we can define a process as a series of activities that are all geared towards achieving a given objective. So the same case with accounting. It's a series of activities that are geared towards the determination of the impact of business transactions on the performance and financial position of a business. So the essential elements of an accounting definition are: one, recording of accounting data, or we can say recording of business transactions. Yeah. So one of the key terms in an accounting definition is the process of recording transactions. So we record these transactions in the books of accounts. That is, we have the journal, and you also have the ledger, where business transactions are recorded. So one key element of accounting is recording business transactions as and when they take place. So all the transactions of a business need to be recorded by the accountant. The second element of a proper accounting definition is classifying and summarizing. Yeah. So data recorded in the books need to be classified in various accounts. So we classify the accounts into various accounts. Yeah. Such accounts such as assets accounts, liabilities accounts, expenses accounts, revenues accounts, and capital accounts. So that involves classifying. Yeah. So we classify, so we have various transactions, numerous transactions. These transactions need to be classified. So that's another key element of an accounting definition. And then we have summarizing, which is another key element of an accounting definition. So summarizing facilitates the determination of profits and losses. Yeah. So we have a lot of many transactions, yeah, taking place in a given period of time. Yeah. So it would make a lot of sense if these many transactions can be summarized, yeah, in a small report that can be given to the various stakeholders of the business, yeah, to give a report to communicate the impact of the numerous transactions on the financial performance and on the financial position of a business, so that we're able to tell that the business has made this much in terms of profit or losses. So summarizing. So classifying and summarizing are key elements in an accounting definition. The other key element is communicating information. Yeah. So the reports derived from classifying and summarizing business transactions is communicated to the various interested persons. Yeah, the stakeholders of the business, or in this case, we refer to them as the users of financial information. Yeah. So people like the owners of the business, the suppliers of the business, the lenders, the banks, the customers, and the general public. They are all in need of the financial information of a business. So, and accounting comes in to provide that information. Information on profitability and information on the financial position of the business. And then another key element of a financial accounting definition is business transactions. Yeah, I think I've talked repeatedly about accounting being the process of recording business transactions. Yeah, the process of recording transactions. Transactions is a key element in accounting. Yeah, a transaction is defined as an activity which takes place for a business reason. So those activities that take place in the business, those activities, we refer to them here as transactions, need to be recorded that on this and this date we sold this item, this and this date we bought this item, this and this date we paid for electricity, this and this date we fired some staff, and so on. So these activities ought to be recorded in the books of accounts and in the journal. So accounting has this role of recording business transactions. One thing to note about business transactions is that we have financial transactions and non-financial transactions. Accounting only records financial transactions. Financial transactions are those which involve money, yeah, which can be quantified in monetary terms. A financial transaction is that which can be quantified in monetary terms. You can actually attach the value of money to this activity. Yeah. So financial transactions which can be quantified in monetary terms is the only transaction that can be recorded in the books of accounts by the accountant. Non-financial transactions cannot be recorded in the books of accounts. A good example of a non-financial transaction or activity is hiring of a new employee. So you've just employed someone, no money has been spent. Yeah, so that's not an activity that should be recorded by an accountant. This is an activity that can be recorded by the human resource manager. It's a human resource manager that deals with the hiring and firing of employees. So hiring of employees doesn't involve any monetary claim as such. Uh, as such, it needs not to be recorded by an accountant. It can be recorded by the human resource manager. So we only record those transactions that are of a financial character, yeah, that involve money. Yeah. So when the managers have a board meeting, no money is spent, no need to record that activity because there's no money involved. That is in accounting. So in accounting, we only record those transactions that are of a financial nature. So it's important to note that transactions to be recorded in the books of accounts, they have to be they have to be of a financial character. So activities such as hiring of a new employee or conducting a lecture that do not involve the transfer of money are thus not recorded in accounting. They can be recorded by another professional. Like I've said, the human resource manager will record the hiring of a new employee. Another key term that may have been left out in this note is the analysis. Yeah, analysis of the impact of business transactions on the financial performance and position of the business. So as an accountant, you need to be able to tell that these numerous transactions affected the profitability of the business this way. Yeah, because we had many sales, the profits of the business have improved. Yeah, so the analysis is also another key element of an accounting definition. The analysis of the impact of a business's transactions on its financial position and the financial performance of the business. So I hope you're all together. So next we look at another definition, that is bookkeeping. So bookkeeping is defined as the art of recording business transactions in a systematic manner. It is a process of recording in the books of accounts all those business transactions that result in the transfer of money or money's worth. Yeah. So bookkeeping is that. So what to note about bookkeeping is that bookkeeping is a part of accounting. That part of accounting that merely deals with recording of business transactions. Yeah. So bookkeeping merely deals with recording of business transactions. Just that. Kuandika tu, kurecord. So the transaction takes place, they note it down in the books of accounts. They put it in the ledger, they prepare the source documents like the invoices, the the cash sales and receipts and so on. So that's the work of a bookkeeper, merely to record. The bookkeeper doesn't summarize, the bookkeeper doesn't classify, the bookkeeper doesn't report the impact of transactions on the financial performance and position of the business. So I can give a good example of a bookkeeper in an organization. So um, in many organizations, we have a hierarchy. Yeah, we have the person at the top there and the person at the bottom in that business. So the top you find the accountant, or in most cases they are known as the financial managers. That's the accountant. His job is to record business transactions, classify, summarize, and communicate the effect of these transactions on the financial performance and position of the business. And then at the bottom there you have the accounts clerks, whose job is merely to record. Yeah, they don't do the communication. The communication is made at the top to the public. It's at the top. Yeah, it's the CEO, it's the accountant who communicates the profits of the business. But down there we have the accounts clerks, whose job is merely to record business transactions in the books of accounts. So that is bookkeeping. So bookkeeping is for the clerks, accounting is for the persons at the senior level. Yeah, accounting is for the persons at the senior level, whose job is to do all those activities in accounting: recording, classifying, summarizing, and reporting. Whereas at the bottom, we have the accounts clerks, whose job is merely to record transactions in the books of accounts. So therefore, here we have accounting versus bookkeeping. So you can see that accounting has a wider scope than bookkeeping in every organization. So while accountants record, classify, and summarize business transactions, bookkeepers are merely involved in recording of business transactions. Yeah. So bookkeepers, yeah, kazi yao ni data entry. The person who key that data into the system or in the books of accounts. So functions of accounting, or rather the objectives of accounting. So we have several, but in our case, we shall look at a few of them. So one is ascertainment of profit and loss. Yeah. So most businesses are established to make a profit for the owner of the business. So as such, the owner of the business needs to know what profit has been made. And for him to know the profit, proper books of accounts have to be kept. The trading on the profit and loss account, or rather the income statement, has to be properly prepared so as to give the net profit and the gross profit of the business for a particular period of time. And accounting serves that role very well. So for the accurate and complete recording of business transaction, it is uh, uh, accounting and complete recording of all business transactions is essential in the determination of profit and losses. So accounting will serve that purpose very well. It's accounting in that organization that is able to tell whether the business has made a profit or a loss, because it's the accountants who prepare the profit and loss account, which shows the profit or loss that the business has made. Then number two objective of accounting is to facilitate credit transactions. So accounting records facilitate credit transactions because these records will determine the amounts due to creditors and amounts due from debtors. It's not done here, but due. The amount due from debtors. Yeah. So accounting will facilitate credit transactions. Yeah. It's only when accounting records have been properly kept that you're able to tell that this is a risky business or this is a credit-worthy business. Yeah. Because looking at its balance sheet, this business has not borrowed, has not overborrowed. Yeah, the business is stable. It has enough assets to pay these liabilities. So as such, you can facilitate credit. We can extend credit to this business because it has sufficient assets to pay its current credits or debts. So accounting will serve this purpose very well. It will help the bank or the lender to determine the credit position of the business so as to be able to extend credit to this business. Then number three, we have accurate assessment of tax. So accounting facilitates the accurate assessment of tax by availing records which show the profit or loss that the business has made or incurred. So without a proper accounting system, the business will not be in a position to pay the correct amount of tax. The business may pay may overpay taxes or may underpay taxes. If it overpays taxes, that is a loss to the business because it's losing too much money to tax. On the other hand, if it underpays the taxes, this may come with some fines. Yeah, KRA is known to fine the taxpayers who have not paid tax properly. So to avoid these problems of paying tax or losing money to tax, then you need to have a proper accounting system that gives the accurate figure for paying tax. And as such, you need a proper accounting system, which will give us the accurate figure of profit in order to repay the right amount of profit. We also need a proper accounting system to help us pay in paying taxes like VAT. Yeah, so we pay VAT on our sales and purchases. If our sales and purchases have not been properly recorded, then we just be guessing how much VAT we are going to pay to the government. In which case we may overpay or underpay, which in both cases is a problem to the business. Either way, we overpay, we are losing money to the government unnecessarily. We underpay, we are fined. We are in legal problems with the government, and no one wants to be in a legal problem with the government. So it's important to have a proper accounting system so as to pay the correct amount of tax. And then the other function or objective of accounting is for the evaluation of assets and liabilities. So through a balance sheet, details relating to assets and liabilities are shown. So this shows the financial position of the enterprise, and it can be used as a security for a loan. Yeah. So accounting serves this purpose very well. Through the balance sheet, it's able to show the assets and liabilities of the business. So you're able to tell that this business has this amount, this worth of assets. It owes this much in liabilities, like that. So evaluation of assets and liabilities is also another objective of accounting. And then another function or objective of accounting is a tool for control. Yeah. So I know you guys are doing principles of management, and you guys will be managers in future. So control is one of the functions of a manager. And what does control mean? Control means to realign yourself or the organization towards your objectives. Yeah. So the question is, are you meeting the objectives that you intend to achieve? Yeah. So in that case, you are doing a control. It's like at a personal level for you as a student. I know you have coronavirus, so learning is not normal. But assuming when there was no corona and learning was physical, you are here in campus and you're making friends. So you come here as a very innocent young lady, young man, yeah, who has a vision with him, who wants to graduate maybe with a first class, go get a good job. Yeah, so you come here very innocent and you tend to join a funny group of friends who may mislead you. Yeah, so you find yourself swaying from the original objective. So you're away from the academics. Now you're doing some. Yeah, so you find yourself losing track. Yeah, so you find yourself not performing well in class. So at that point, you you call yourself into a small meeting and evaluate your performance and what has led to this performance if it's a negative performance. So then you take some corrective action, yeah, to help you improve in academic performance, to improve in your whole self, that is. So at that point you are doing some control, yeah. So you need to control your activities, you need to control your expenditure in order for you to achieve an objective. That's at a personal level. That's something that normally everybody does. So the same case for organization, yeah, they all need to do some control, yeah. So to reevaluate themselves, to determine whether they are on the right path of achieving their objectives or not. If they are not on the right path, do some corrective activity to help them revert to the path of, say, profitability. So accounting will facilitate control in an organization, because if an organization is making losses, then we need to know where the losses are coming from, and the financial statements can show that. So it can show that our expenses were too much, so we need to control our expenses. Yeah. So a proper and accurate accounting system will be helpful in controlling unnecessary expenditure and misappropriation of funds. Yeah. So as to help the organization still achieve its objective of making profit. So accounting serves that role very well. That is the role of tool for control. Then accounting can also be used as a base for further planning. Yeah. So as managers, I know you are educators, but you'll be managers, God willing. So another function of a manager is planning, to set objectives to achieve. Yeah. So by the end of the year, I want to have achieved this. Yeah. So organizations also have goals to achieve. Businesses will have that goal of profit maximization. We want to maximize our profits. Yeah. So how do we set these goals of profitability? Yeah. Well, for us to set a profitability a goal, one thing we learn in management is that a goal has to be SMART. SMART is an acronym. Yeah. Now the goal has to be specific, measurable, attributable, realistic, and time bound. So that is an acronym for SMART. Yeah. So to make SMART goals, a goal that is realistic, we need to come from a realistic background. That if this is a business that has been operating, these are the profits that it has been making, and this is the most realistic profit that you can achieve. With this investment, with this, if we bring in resources of this, to the business, new resources, we add to the current resources, we'll be able to improve our profits from here to this much. So accounting will give us that realistic ground of us being able to make a realistic goal, of us being able to make a measurable goal of profit. You cannot be a small organization making profit of say 100,000 shillings and then you just wake up one day and you assume that you make a profit of 1,000,000 shillings unless something has been made, unless an investment has been made. So you need to be realistic. Accounting gives us that sufficient information to help us in making goals. So accounting can provide sufficient data relating to sales, profits, investments to facilitate making decisions about future programs. So that, students, those are some of the objectives of accounting. So I've not exhausted all the objectives of accounting. So yeah, so any relevant objective will apply. So we move forward to the users of accounting information. The users of accounting information are basically the persons interested in the affairs of the business. They are also referred to as the stakeholders of the business. Persons whose activities may be affected by the activities of the business, or person whose activities may affect the affairs of the business. Yeah. So examples of these persons, of the users of financial information, we have is the owners or the entrepreneurs, also known as the shareholders of the business. They have invested capital into the business. They have invested in the business. Examples of such owners include the sole traders, that is the entrepreneur. We have the partners in a partnership. We have shareholders in a company. So information in accounting will help them to assess how the managers of the business are performing and whether the business is profitable or not, and whether to make drawings or put in additional profit. So the owners are mainly really interested in the profitability of the business. So they established this business to make a profit, to earn a return for themselves. So they want to know whether this business is making a profit or loss. As such, they need this information. They need the profit and loss account. They need the trading and the profit and loss account to know whether the business has made a profit or loss. So it's the accounting, financial statements will serve this purpose to the owners. They provide information on the profitability of the business. And then the other users of financial information are the customers of the business. So the customers rely on the business's goods and services. They would like to know how the business is performing and its financial position. So this information will enable them to assess whether they can rely on the firm for future supplies. So customers, serious customers, like say the government, yeah, they would want to know whether their suppliers are, are what? Whether their suppliers are capable of supplying to them as and when the supply is needed. Yeah. So they want to assess the capacity of the business to supply on time. So you don't want to deal with someone whom you call him today and it takes him a whole month to supply, whereas these goods maybe are needed maybe in a day's time. So you want someone who is capable, someone who is well endowed. So as such, as a serious customer, you may have to assess the financial statements of this business so as to assess its capability, its strength in supplying these goods as and when they fall due. So you may have to look at the income statement or the profit and loss account to see its past sales, how this company has been trading in the past. Will it be able to supply you this much if it has been selling this much? Or look at its balance sheet. Look at its cash position. Does this company have enough cash able to obtain the raw materials or the inputs to sell to you? Does it enough? Look at its stock in the balance sheet. Does this company have enough stock to supply? So you assess the capacity, the strength of the company in supplying to you as and when a need arises. So another group of users of financial statements we have is the suppliers. So the suppliers of goods or services to the firm, the supplies are either for cash or credit. The suppliers would like to have information on the financial performance and position so as to assess whether the business will be able to pay for the goods and services provided as and when they fall due. So the suppliers supply goods to the company, to the business. Yeah. In some cases, they supply on credit basis. So the suppliers would need to want to know whether this business will be able to pay for these credit purchases as and when they fall due. So as such, they may be forced to look at the balance sheet, the cash position of the business, the creditors position of the business, the assets of the business, and be able to assess whether this business is in a position to pay for these credits as and when they fall due. So such suppliers are also users of financial statements. And then we have managers. Managers are involved in day-to-day activities of the business. They manage the business. They have been entrusted with the resources of the business by the owners. So they make decisions. They take activities on a day-to-day basis with the objective of making a profit for the business. Yeah. So these persons would want to evaluate their own performance. And one of the ways to evaluate their own performance is by looking at these financial statements. Like say, are you making enough profits or not? Yeah. Also, in order for them to be able to make plans for the future. We've seen that accounting, one of the objectives of accounting is as a base for further planning. So for us to plan, yeah, we need to come from a background. And this background the information can only be obtained from the financial statements. So the financial statements will help the managers to plan. Yeah. So the managers would like to have information on the financial performance, financial position, and changes in financial position so as to determine whether the business is operating as per the plans. In case the plan is not achieved, then the managers need to come up with appropriate measures to ensure that the set plans are met. So managers. And then we have lenders. Lenders are like banks. Yeah, banks advance credit to the business. So banks want to know the credit worthiness of the business. So to know the credit worthiness of the business, you look at the financial, at the balance sheet, and be able to tell whether this business will be able to pay these supplies as and when they fall due. So lenders have provided loans and other sources of capital to the business. Such lenders include banks and financial institutions. So lenders would like to have information on the financial performance and position of the business so as to assess whether the business is profitable enough to pay interest on the loans and whether it has enough resources to pay back the principal amount when it is due. So lenders, like the credit suppliers, they advance credit to the business. They want to know the credit worthiness of the business. So to achieve this, they look at the balance sheet, the assets, yeah, to ascertain whether the business is profitable enough to pay interest on loans and it has enough resources to pay back the principal amount when it's due. So such lenders will need to look at the balance sheet to be able to ascertain that. And then the other group of financial or users of financial statements is the government and its agencies. The government is in need of tax. It needs the accurate tax. So to prove this tax, it needs the financial statements of the business. So the government is another credible user of the financial information of a business. And then you have financial analysts and advisors. These persons advise investors on which companies to invest in. So for them to make a decision on which company to invest in, they need to determine the strong companies financially, the profitable companies. And to be able to establish which is the most profitable company, they have to compare the profit and loss accounts of different companies. Now to tell which company is more profitable. So as such, financial analysts will need financial information in order for them to be able to advise investors on which companies to invest in. So financial analysts and advisors interpret financial information. Examples of financial analysts, we have stockbrokers who advise investors on shares to buy in the stock market or other professional consultants like accountants. They are interested in the financial position and performance of the business so that they can advise their clients on how much is the value of their investment, whether it is profitable or not, and what is the value. And then we have employees as users of financial statements. Employees earn a salary from the business. They work for the business. In return, they are given a salary. So in most cases, the employees want to earn a good amount of money. So if they want to earn a good amount of money, the business should be able to pay that. So you may find the employees striking because they need a salary increment. So for them to claim for a salary increment, then they have to be supported by their financial statements that the business is capable of this pay rise. Yeah, this hike in profits, is a business capable of paying that? So they need to look at the financial statements first in order for them to make a claim. So the employees, they work for the business. They would like to have information on the financial position and performance so as to make decisions on the terms of employment. This information would be important as they can use it to negotiate for better terms, including salaries, training, and other benefits. And then we have the general public, another user of financial statements. The general public is affected by the activities of the business. Yeah. So the business needs to report its affairs to the general public because the business is a part of the society. The business affects the lives of the society, and as such, the business has to be accountable to the society. So, yeah, so as such, the public is also a stakeholder and in need of the financial information of the business. So you've heard of businesses engaging in corporate social responsibility, and as such, these businesses also need to report its activities in terms of corporate social responsibility to the society. So those are some of the users of financial statements. Then next, we'll look at the final item in our today's lesson, the accounting equation. The accounting equation is also known as the balance sheet equation or the bookkeeping equation. I know this is not the first time you've heard of this equation. Yeah, also known as the bookkeeping equation or the balance sheet equation. It shows the equality between the assets of the business and the liabilities and capital. Or rather, it shows the equality between the resources of a business, which in this case are the assets, and the sources or claims to the assets, that is the liabilities and capital. So a business has resources. These resources will be used to generate profit. But these resources have a source, and they come from the owners of the business. Yeah, it's the owners of the business who bring in resources, who invest their resources into the business, and then these resources are used to generate profit. But in some cases, you find that the resources provided by the owners of the business will not be enough. As such, the business will have to borrow to supplement the need of more resources. Yeah. So the borrowed resources are known as liabilities. And the resources provided by the owner is known as the capital. So as such, the accounting equation will be assets is equal to liabilities plus capital. Yeah, which is in the same case as the resources of the business is equal to the sources to the resources or the claims to the resources. So out of these resources of the business, there is a claim of the owners and there is a claim of the lenders, the borrowed resources. Yeah. So as such, you have the balance sheet equation, which on one side you have the assets, that is the resources of the business, and on the other side we have the sources to the resources. In which case we have the liabilities plus capital. In which case liabilities is the borrowed resources, and capital is the resources contributed by the owner of the business. So yeah, I think these are a lot of I think I've tried to summarize that. So these notes I've sent them to you, so please go through them. So the assets, you all know what assets are. The assets are the resources of a business which have the potential of generating economic benefit to the business. Then you have capital, which are funds that are contributed by the owners of the business. So capital is the owner's claim into the assets of the business. Then we have liabilities, of which the liabilities is a claim of the non-owners into the resources of the business. The non-owners are those persons who have lent their resources to the business. The business has borrowed from the liabilities, and so on. So as such, the balance sheet equation is assets is equal to capital plus liabilities. So look at this item, each of these items in details. So what is an asset? So an asset is a resource controlled by a business entity or firm as a result of past events for which economic benefits are expected to flow to the firm. So that's a definition of an asset. It's a resource controlled by a business as a result of past events for which economic benefits are expected to flow to the firm. So one thing to note is that it's a resource controlled by a business, yeah, whose economic benefits are expected to flow to the firm. So if this asset is properly utilized, it will lead to some inflow of money. Yeah. So if it's a machinery, this machinery will be able to be used in the production process of goods. These goods are sold and they have money comes in, which is a return to the business. So an example, anyway, so there are classifications of assets. Assets are classified into two. So we have non-current assets and we have current assets. So non-current assets are those which last in the business for a period exceeding a year. Yeah. And current assets are those which are held by the business for periods which are less than a year. Yeah. So non-current assets, these are acquired by the business to assist in earning revenues and are not for resale. They are normally expected to be in the business for a period of more than 1 year. Then current assets, also known as fixed assets, they are expected to be held for periods of more than 1 year. They are not for resale. They are basically acquired for their use in earning of revenues. Examples of non-current assets, we have land and buildings, plant and machinery, furniture fittings and equipment, fixtures, and motor vehicles. Normally, the business does not acquire a fixed asset to sell. It acquires this fixed asset to help it in generating incomes, to help it in production of goods and services in order to generate income through sales. So non-current assets. And then we have current assets, which are not expected to last for more than a year. They are in most cases directly related to trading activities of the business. They are either in the form of cash or are convertible into cash within a year of the balance sheet date. Yeah. So current assets are either in the form of cash or are convertible into cash within a year of the balance sheet date. They are temporary. They are very short-term assets which can only last in the business in periods not exceeding a year. So examples of current assets, we have stock, we have debtors, we have other debtors such as prepaid expenses, and we have incomes accruing. Another example of current asset is cash at bank and cash in hand. And that is it. And then we have liabilities. Yeah. Liabilities are obligations of a business as a result of past events whose settlement is expected to result in an economic outflow of amongst the firm. So an example is when a business buys goods on credit, the firm has a liability called a creditor. The past event is a credit purchase, and the liability being paid to the creditor will result to an outflow of cash from the business. Basically, a liability is a financial obligation of a business whose payment will result to an outflow of funds from the business. Yeah, it's a financial obligation whose payment will result to an outflow of money, of cash from the business. And it is as a result of a past event. Yeah. So a good example is a creditor is as a result of buying on credit basis. So you've seen that liabilities is a source of the resources of the business. Yeah. So they give us resources. We borrow resources from these liabilities. So liabilities are classified into two. Like for the assets case, we have the non-current assets, also known as the the non-current liabilities, also known as long-term liabilities, which are expected to be paid in periods exceeding a year from the balance sheet date. And then we have current liabilities, which are expected to be paid within a year from the date of the balance sheet. So non-current liabilities are expected to last or be paid in periods exceeding a year. This includes long-term loans from banks and financial institutions. And then we have current liabilities, which last for periods of less than a year and therefore will be paid within a year. So examples of current liabilities, we have trade creditors or accounts payable. We have other creditors. Examples of other creditors, we have outstanding expenses and incomes received in advance. And then another example is a bank overdraft. Yeah, a bank overdraft. A good example of bank overdraft currently we have is Fuliza. Yeah, whereby the bank allows you to spend more than what is in your account. An overdraft. So you have a negative balance in your account. A good example is Fuliza. And then you have capital. It's obvious that capital is a claim by the owners of the business. Yeah. The claim by the owners of the business is capital. The claim by the non-owners of the business is liabilities. I hope you are together there. Yeah. Then you have another look at an example there to illustrate the concept of the balance sheet equation. So you have this equation that D. Moody had the following assets and liabilities as on 31st April 2002. So you have those assets and liabilities, you have creditors, equipment, motor vehicles, stock, and the amounts are given there. Then you also have debtors, cash in hand, and cash at bank. So during the first week of May, Moody undertook the following transactions. A, bought extra equipment for that amount. B, bought extra stock by check. C, paid creditors. D, debtors paid. And E, Moody put in extra 1,000 shillings as cash as capital. So required, determine the capital as at 1st May 2002, and B, drew up a balance sheet after the above transactions have been completed. So A, determine capital as at 1st May 2002. So to determine capital in this case, it's quite simple. So the solution, we use the accounting equation to determine capital. So the accounting equation or the balance sheet equation or the bookkeeping equation, we said it's assets is equal to capital and liabilities. So if you have not been given capital, then it's simply, the capital is simply equal to assets minus liabilities. So in our case here, you've been given a list of assets and liabilities. So with this list of assets and liabilities, you're able to get capital, of which you take all the assets, deduct all the liabilities, and we get the capital. And that is what has been done here. So 148, 120 minus 15, 800, which is equal to 132, 320, which is the capital. So I've not been able to show the workings here, but if you take, so creditor is a liability, but if you take equipment plus motor vehicle, equipment is an asset, yeah? You take equipment plus motor vehicle plus stock, they're all assets, plus debtors, plus cash at bank, plus cash in hand. These are all assets. We only have one liability, that is creditors. We only have one liability, that is creditors. So if you take the sum of equipment, which we agree is an asset, the other asset is motor vehicle, stock, debtors, cash at bank, and cash in hand. If you take the sum of these 6 items, it will be equal to 148, 120. And then the sum of liabilities, we have only seen one liability in this case, which is creditors, 15,800. So less the liabilities is 15,800. What you get is 132,320. And 132,320 in this case is now the capital of the business. So in this case, we've just played with the accounting equation. I know you are good in algebra or in equations. Yeah. So you can all easily see that capital is equal to assets minus liabilities, or assets is equal to capital plus liabilities, or liabilities is equal to assets minus capital. I think we can all easily see that. I hope you are together. And then the other part of the question, we are required to draw up a balance sheet after the above transactions have been completed. So to draw the balance sheet, we need to take into consideration the effect of these transactions on the above balances. So we have the workings shown here. We have the workings shown there. So you look at them. So the first transaction, so we take into consideration the effect of this transaction. So one, bought extra equipment on credit for 5520. So in accounting, we have the duality concept. According to the duality concept, transactions are taken to have two effects on the affairs of the business. Transactions are taken to have a dual effect on the financial position and affairs of a business. So for every transaction, there has to be a dual effect. That is what you have to note. So like in this case, I bought extra equipment on credit 5520. So in this case, we have equipment coming into the business. Equipment are increasing. And at the same time, we have a creditors increasing out of this transaction. Equipment are increasing, creditors are increasing. So as such, to incorporate the effect of this transaction, we add 5520 to equipment and add 5520 to creditors. So like we can see here. So to equipment, we've added 5520, and to creditors, we've added 5520 out of that transaction. We move on to the next transaction. B is that bought extra stock by check 2280. So the dual effect here is that stock increases and bank decreases. Yeah, the amount in the bank will go down and the stock will increase. So therefore the stock will increase 220, that is we add 220, and in the bank we deduct, we minus 220 from the bank. So that is a dual effect. So stock, we add 220 to 2280, and bank, we minus 2280. We move on to the third transaction. Paid creditors by check 3160. So in this case, the dual effect is that the creditors will reduce. So we minus from the creditors 3160, because when you pay them, the liability will go down. Yeah? And then the check will also decrease. The bank will also decrease by 3160, because that 160 has been withdrawn. So as such, we minus that 160 from creditors and we minus that 160 from the bank. So as you can see, for creditors, we've minus that 160, and in the bank, we've also minused that 160. We move on to the next. Debtors paid that 360 by check and 240 by cash. So these are two transactions. We first deal with up to where I've highlighted. So debtors paid that 360 by check. So in this case, the debtors will, the dual effect is that the debtors will reduce and the bank will also reduce. So when they pay us, the debt that they have with us decreases. So the debtors will therefore reduce by 360, and the bank will also reduce by that 360. So as you can see, the bank, cash at bank, that 360. Oh, sorry. Debtors paid. Oh, when the debtors pay, sorry. Pardon me for that. When the debtors pay, it means they have given us money. So when they give us money, money will increase. So therefore, the bank will increase and the debtors will decrease. So therefore, debtors decrease by that 360 and the bank will increase by that 360. So as you can see, bank increases by that 360 and debtors will decrease by that 360. Oh, I can see there's a mistake here. This should have been that 360, not that 600. So please note that mistake. Then we have the other part of that transaction. They also paid 240 by cash. The dual effect here is that cash increases by 240 and debtors decrease by 240. So as you can see, debtors decrease debtors here should have decreased by 240. You can see there is a small mistake here. There should have been minus 240 here. Or am I wrong? Yeah, debtors should have decreased by 240. I don't know why it has not decreased by 240. Or there is something wrong with me. Where's my calculator? Please bear with me. 23,080 minus 3,600 minus 240 gives 19,240. Anyway, I don't know. Yeah. So the dual effect here, debtors paid the 360 by check and 240 by cash. So when they pay, they decrease. So as such that 360, oh, so I'm that 600 is a total of that 360 plus 240. My bad. Anyway, it took me long to know where the problem was. Anyway, but that is correct. So this 3600 should have been split into that 360, and then we should have also seen minus 240 here. So please note that. And then the other transaction is E. Moody put in extra 1,000 shillings cash as capital. So here the dual effect is that cash increases by 1,000 and capital also increases by 1,000. When Moody brought in cash, cash increased in the business. So cash increases by 1,000 and capital also increases by 1,000 shillings. So as you see here, cash in hand increases by 1,000 and capital also increases by 1,000. Then in the end, we have the balances after the transactions have been taken into consideration. And then there are also note that there are items that have not been affected by those transactions, like equipment. So equipment, the way we began with it in the opening balance is the way we have it in the closing balance, because there was no transaction affecting equipment. All the other items have been affected. So you can, as you can see, equipment, there is no increase or decrease because there was no activity. And then down there you have the balance sheet as on the after 1 week, and we have the amounts, the figures here given are the closing balances as seen from these workings here. So when we substitute all of them here properly, we have our balance sheet as it is there, and the balance sheet has to balance, as you can see. So, and that is it. Thank you. So let us have a discussion on Google Meet.